Hello friends, in this video we are going to see the balance sheet. Okay, last part of final accounts. There are two final accounts, income statement and balance sheet. Statement include the two parts, that is trading account and profit and loss account. Then we prepare the balance sheet. In this video we are going to see in detail balance sheet. Balance sheet is a statement of asset and liability of a business enterprise at a given date. It is prepared at the end of accounting period after the trading account and profit and loss account have been prepared. First, we prepare the trading account in this type of final accounts. In trading account, we record the purchase return, sale return and direct expenses, and balancing figure, that is gross profit and gross loss, we transfer to the profit and loss account. In profit and loss account, we record operating expenses and non-operating expenses on debit side and non-operating income on credit side. And at the end of profit and loss account, we calculate the net profit or net loss. That net profit and net loss we transfer into the balance sheet capital account. That's why it is a prepare at the end of accounting period after the trading account and profit and loss account have been prepared. Balance sheet shows the financial position. Income statement shows the profitability. Balance sheet shows the financial position of the business at the end of accounting period. It is called balance sheet because it is a sheet of balances of a ledger account which are still open after the preparation of trading and profit and loss account. The purpose of preparing the balance sheet is to know the true and fair views of the business as a going concern during a particular period. We want to know the true and fair view of the business or financial status of the business. For that purpose, balance sheet is prepared. The balance sheet is one of the important statements which are used by the owner or investors, okay, to measure the financial soundness of the concern as a whole. A statement is prepared to show the list of liabilities and capital of the credit balances of the businesses on left hand side, and list of assets and other debit balances are recorded on the right hand side, which is known as balance sheet. As per the American Institute of Certified Public Accountant, they define the balance sheet as a tabular statement of summary of balances, that is debit and credit, carried forward after an actual and constructive closing of books of account and kept according to the principle of accounting. Okay. And the balance sheet is also described as a statement showing the sources of fund and application of capital or fund. See, sources of fund means from where we borrow the fund. That is nothing but the liability side. And application of fund or capital means where we use that fund for purchasing assets, that is application of fund. That's why balance sheet is also described as a statement showing the sources of fund and application of capital or fund. This is a pro forma of balance sheet. In this we are going to see in detail assets and liability and owner's equity. Equation of balance sheet is assets is equal to liability plus owner's equity. Okay, one by one we are going to see assets, liability and owner's equity. Assets. What is mean by assets? Assets is nothing but what an entity owns is called as asset. Okay, what an entity owns is called as asset. These assets are utilized in the normal course of business operations to produce the goods for sale in order to generate the profit. An asset is the result of past economic event and the same is able to generate future economic benefit in monetary term to any business. The assets are grouped into four categories, that is current assets, fixed asset, intangible assets and fictitious asset. Current assets, first of all we are going to see the current assets. Current assets are the assets of the business which Current assets are the assets which are required during normal course of the business, that we call it as a current assets. Current assets are cash in hand, cash at bank, sundry debtors, short-term investment, stock in trade, bill receivable, prepaid expenses and accrued income. Cash in hand means the fund available for day-to-day operation, that is cash in hand. Cash at bank, fund available in business bank account, that is cash at bank. Sundry debtors, okay, means credit sale. This term is related to credit sale. Okay, sundry debtors are the account receivable amount owed to the company by debtors. Debtors means unpaid customer account, or we can say the sundry debtors are the amount owed to the business generally by its customers arising out of credit sale, that we call it as the sundry debtors. Short-term investment, then stock in trade is nothing but the inventory. Bill receivable again is the also credit sale, but bill receivable are the acknowledgement of a debt of the customers. When the amount owed by the debtors are evidenced by a written promises to pay or acceptance of an order to pay are called as bill receivable. Okay, then prepaid expenses. Prepaid expenses are the kind of expenses which are paid in advance. Okay, this represent the kind of assets usually of an intangible nature, usefulness of which will expire with the near future, that we call it as a prepaid expenses. These expenses which are usually paid in advance, for example rent, tax, insurance, but the entire portion could not be recognized in the current accounting period because the benefit is spread over more than one accounting year. Okay, that is prepaid expenses. For that we need the adjustment. Accrue income. Accrue income is that income which has been earned but has yet been received or has not become due. That we call it as a accrue income. Another part of current asset is liquid assets. See, current assets are the converted into cash, but liquid assets are those assets which are immediately converted into cash. In these current assets, cash in hand, cash at bank, sundry debtor, short-term investment, bill receivable and accrued income are the liquid assets. Only prepaid expenses and stock are not liquid assets. Okay, liquid assets are the assets which are immediately converted into cash. Then fixed asset. Fixed assets are the assets which having a specific value, or we can say which are not consumed during the normal course of business and trade but provide the means for producing the sellable goods or producing the services, that we call it as a fixed asset. Fixed assets are divided into tangible and intangible. Again, tangible assets are the assets that have a physical existence or and can be seen and felt. For example, land, building, machinery, equipment, furniture, loose tool are the example of tangible assets. Then intangible assets. Intangible assets have no physical existence and cannot be touched. Rather, they represent the legal right or economic benefit. For example, goodwill, copyright, trademark and patent are the intangible assets. Now, fictitious assets is also one type of intangible assets, but there is slight difference between the fictitious assets and intangible assets. Fictitious assets have no physical existence. These are the expenses incurred in running the business. Also, there is a no resale value for fictitious assets, and also they are amortized over the several years. That we call it as a fictitious assets. For example, fictitious assets are promotional expenses of a business, then preliminary expenses, that is license fee, legal charges, cost of incorporations are the preliminary expenses are the part of fictitious assets. Another part of fictitious asset is discount on issue of debentures, loss on issue of discount on issue of shares, discount on issue of debentures, are the example of fictitious assets. Fictitious assets are the revenue expenditure, deferred revenue expenditure, which have no resale value, that we call it as a fictitious assets. This is all about asset. Asset is means what an entity own. Assets are current assets, fixed asset, intangible assets, and fictitious asset. Now we are going to see the liability. Okay, what is meant by liability? Liability is nothing but what an entity OV is called as liability. Or liabilities are the debt or outstanding which are owned by the farmer, business, or company, that we call it as a liability. Or it is an economic obligations of an enterprise, that we call it as a liability. Liabilities are fixed liability, current liability, and contingency liability. Okay, fixed liability. Fixed liabilities are long-term liabilities which are generally redeemed after a longer period, that is 5 to 20 years, that we call it as a long-term liability. Loan from bank, loan from mortgage, debentures, or any other long-term loans are called as long-term liability. Then current liability. Current liabilities which are expected to have been paid within 1 year, that we call it as a current liability. When current liability is created, it increases the resources of a business in the form of current assets. For example, buying inventory on credit, that will increase our stock, that is the part of current assets. Okay. Current liability are generally obligations for the item that are enter into the operating cycle of a business. For example, sundry creditors, bill payable in the acquisition of inventory. Okay, then bank overdraft, then outstanding expenses are the example of current liability. Now, bill payable. Bill payable are the claim of the supplier which is evidenced by a note or some other written acknowledgement of debt, that we call it as a bill payable. Then sundry creditors are the claim of the supplier against the business for the delivery of goods on credit, which may not be evidenced by a written acknowledgement of debt, that we call it as a sundry creditors. Bank overdraft is a short-term loan from the bank, that is bank overdraft. Outstanding expenses are the expenses which are already incurred but not paid for. These expenses are the conversion of prepaid expenses. Okay. These liabilities may be intangible in nature in the sense that they are evidenced by a legal document. The example of outstanding expenses are outstanding wages, outstanding salary, outstanding rent, outstanding electricity bill are the example of outstanding expenses. Now we are going to see the capital part. This includes the owner's equity. Owner's capital is nothing but the fund provided by the proprietor. As we have seen the profit and loss account, net profit we carry down in the capital account of balance sheet. If there is a profit, we add that amount in the opening balance. If there is a loss, that we subtract from the capital account. Okay. And also we add the interest on capital. Then reserve and surplus, that is general reserve, reserve for contingencies, reserve for sinking fund. The profit generated for the business is divided into two parts, as some part is distributed among the shareholders in the form of dividend and some part is reserved for the business, that is reserve and surplus. This is all about the balance sheet, pro forma, and all the components of the balance sheet. Now we are going to see what is the difference between profit and loss account and balance sheet. Profit and loss account is prepared with the debit and credit balance of nominal account. Balance sheet, it shows the assets and liability on particular date. Profit and loss account reveal the net profit or net loss of a concern during the particular period. Balance sheet, it is a statement of financial position on a particular date. Difference between the two sides of trading account will be gross profit and transfer to the profit and loss account. The difference between the two sides of the profit and loss account will be net profit or net loss, transfer to the liability side of balance sheet. The debit and credit balances of nominal accounts are closed by transferring profit and loss account. It is a statement of static in nature, thus account do not require closing them. Now, difference between the trial balance and balance sheet. Main objective of preparing the trial balance is to check the arithmetical accuracy of the books of account. Balance sheet to show the financial position of the business enterprise on a given date. When prepare trial balance, frequently prepare at the end of month or quarterly to check the arithmetical accuracy of the books of account. Balance sheet at the end of accounting period. Number of columns are debit balance and credit balance. Balance sheet 2. Liabilities and assets. Type of account. All types of account we record in the trial balance. Balance sheet accounts of assets, liability, capital, and those accounts which are remain open after the preparation of trading and profit and loss account. Treatment of stock. Generally, opening stock appear in the trial balance, whereas closing stock does not. Balance sheet only the closing stock appears on the asset side. Treatment of adjustment. Prepare without making adjustment regarding prepaid expenses, accrue income and income received in advance. Balance sheet cannot be prepared without making adjustment regarding prepaid expenses, outstanding expenses, income received in advance and making provision for possible losses. This is all about difference between trial balance and balance sheet. Thank you.